All right. Good afternoon, everybody. Welcome to Topstep Trading Foundation. This is week 3. Today, we're going to be talking about technical analysis. It's good to see everybody. We're going to start in about 1 minute. See if any latecomers come in. It's great to see everybody. You see people from Milwaukee, from Turin, Italy, Delray Beach, Miami, San Diego, Sweden. It's good to see everybody. Thanks again for joining. We're talking about visiting Sweden. I would love to do that. Vegas.
I've been
Canada,
to Stockholm once.
England. Have you been there?
Yeah, I went around the Baltic once. I've been to Stockholm, Helsinki, St. Petersburg, Gdansk, Berlin, stuff like that.
Wow, that's
great.
a nice trip.
Yeah. As far as the Zoom stuff, I think we got to figure it out. Everyone got an email today. If anyone's joining us and missed yesterday, we apologize. Something happened with our Zoom alerts, but we think it's fixed now. If it ever happens again for any reason, the old links go to the same place.
Excellent. Important safety tip.
Yes, very much.
So, Spencer, you're from Idaho. I've been through Idaho. The Panhandle, really. One of the most beautiful motorcycle rides I've ever been on. But enough about that. We've got some questions already in the Q&A section. You can put your questions in there, of course. And we are, I think we're good to go. Any other comments or ideas, questions, gentlemen?
No, JD, we can share the link to the landing page as usual. If people want to see the link to the Zoom yesterday, I assume it's up there by now. If it's not, it will be soon.
It is. The page is updated. All past episodes are available. I'll throw the link in right now.
All right. Well, with that, we'll get our ugly mugs off here and let you do your thing.
It's always so good to see your smiling faces, though.
Thank you.
All right. So today we're going to dig in a little bit deeper into what it takes to become a successful and profitable futures trader. Got to introduce myself as usual. I'm John Hoagland, the middle-aged performance coach here at Topstep. I've got in February, it'll be 39 years of futures industry experience. Traded on the floor of the Mercantile Exchange for 20 some years. My dad traded on the Board of Trade for 40 years before that. So I've been trading for over 30 years. And in 2009, as the opportunities leaned more towards screen trading, I stepped out of the pit for the last time. Started to relearn trading on screen. There's a relearning process, I think, for anybody who has been a pit trader moving to screen trading. And in 2011, I joined with Topstep, and it's been my absolute pleasure to have the opportunity to talk to thousands of traders from all over the world. You see a lot of folks from all over the world here, and it's great to see you. And we're going to, everything that I do in this regard is aimed at helping traders learn, improve their process, improve their trading. And that's our goal here. Is we want to improve lives, and hopefully we're doing that a little bit at a time. Technical analysis. This is a huge subject, of course. I'm sure we're all aware of that. It's nothing we're going to be able to master in 35 or 40 minutes here. But we do want to touch base and talk about a few things, and very basic things for those of you who may not be aware of some of the things involved in charting and in technical analysis. But technical analysis is a discipline, as they call it here, employed to evaluate investments and identify trading opportunities and price trends and patterns seen on charts. If something has happened one way in the past, it might happen similarly in some point in the future. Technical analysts believe past trading activity and price changes of a security can be valuable indicators of the security's future price movements. Technical analysis, I think, is the basis of most people's trading to some degree or another. there, when we're talking about these things today, there is so much information and so many different ways, so many different charts, so many different things to look at. For us to go through everything would take weeks. We're going to touch base on just a few of the concepts and patterns that we see in trading. I've also, at the end of this presentation, included some reference to websites to hopefully help you continue your quest to be a good technical analyst. There's the CME website, has a pretty good education program right on it. There's also chartschools.com. We'll see that again at the end of the presentation today. That I like, because I mean, it goes all into all different types of charts, into all different chart patterns. It goes into technical patterns. It goes into candlestick patterns, which candlestick patterns I don't even really touch on in this presentation. But all of these things are tools that traders use to make decisions in trading. Sometimes they work, sometimes they don't. There's nothing that works every time, and there's nothing that never works. I don't even like to use the word works. So when we're talking about technical analysis, we're going to be talking about charts, and there's several different chart types that traders use. The candlestick pattern is probably, or the candlestick chart is probably the most popular. Candlestick patterns and candlestick charting really came into prevalence in there. It seemed to be like the early 90s. All of these three charts are representing the same price movement, just in slightly different ways. The candlestick pattern, most of them you're probably going to see are time-based. You've got the 1 minute chart, the 5 minute chart, the 30-minute chart, all the way up through the monthly chart. The only time that they're not time-based is really going to be in tick charts, where the candles are created by a specific number of contracts that are traded before the next candle is created. Okay, then there's the open, high, low, close chart, which is really what I learned on. And it's really the same information. It's just presented a little bit differently than the candlestick chart. This is the same chart right here. So we have the opening of this time period, what this bar represents, and the closing. Here is the opening and the closing. The opening of the next bar right at the bottom of it. The candle moves higher and it closes just off its high. So this is really the same information. I think most people prefer the candlestick chart because it is so visible. It's very easy to see. And then there's specific pieces of it that we're going to go through. I think it's we're going to start at the very beginning. What creates a candlestick? Then there's the open, high, low, close chart, which is this. There's line charts. I don't know anybody that is really, I think, successfully day trading with line charts, but we thought we'd throw it up there. There's also other charts like Renko charts. Now, Renko charts are just a different way to organize information. The Renko charts are built using price movement rather than price and standardized time. Renga is Japanese for bricks. So the charts look like a series of bricks. A new brick is created when the price moves to a specific price amount. I don't look at them. I don't use them. There are those that, of course, find them useful. When you find something that you like, find something that speaks to you, you want to try and stick to it, because changing products, changing charts, changing analyses you end up in just a strategy drift, and you don't do anything consistently enough to get any good information to review. Heikin Ashi, these are also Japanese candlestick charts, but they're an average bar. They don't contain all of the movement of price. And when used in conjunction with candlestick charts, they're useful. They smooth the information. I only know one person that uses Heikin Ashi regularly. And then there's point and figure charts. Point and figure seems to be a lost art. I don't talk to anybody anymore that uses point and figure charts. Just thought I'd throw it up there as just another opportunity for us to learn something. You want to learn something about point and figure charts? The chartschool.com is a good place to look at that. It's a tool that goes one direction, and there has to be a specific pullback for it to change direction. So just to go through the features of the candlestick, owner is saying Heikin are less noisy. They do tend to smooth the information. And a falling candlestick, there's always going to be in either side, whether it's rising or falling. The candle body is the wide part. The shadows are the end. In a falling candle, the opening price is at the top of the candle body. The closing price is at the bottom of the candle body. The shadow, the shadow represents the entire range for this time period, or the entire range until enough contracts have traded on a tick chart to move on to the next bar. So the falling candle, the opening price is here, the closing price is here, and this is the entire range. The rising candle, some platforms use different colors. Some platforms will have a hollow falling candle versus a colored candle. This particular platform is set for red falling candles, black rising candles. Same situation. You've got the candle body here. The shadows represent the entire price range for this time period. And of course, the opening price will be the low of the candle body, and the closing price will be the high of the candle body. Again, different platforms use different colors. You can on most platforms, if not all, you can change the colors of the candles. You can have a purple falling candle and a pink rising candle if you want to. Some people think that psychologically the red falling candle is alerting and pushes them to do things that they may not because of the urgency represented by the red falling candle. Think about that. Some basic technical patterns. Now, these patterns can represent the same information, whether this is a 5-minute chart or if this is a daily chart. Okay, the technical patterns transfer to different time frames. We've had a couple of potential flag breakouts today in gold and in crude oil. We're going to take a look at this in real time here. If this is a 30-minute chart, each bar represents 30 minutes. The market comes up to, it is in a trend to the upside, and a flag forms. It is an upside digestion in this case. In other words, price has come far enough. We need an adjustment in inventory. The flag is a contrary move, smaller ranges, usually lower volume, And we can use these flags for opportunities for reversion trades back towards the center of the flag, or even a full rotation to the bottom of the flag. And once there is a substantial breakout in time, volume, momentum, then we go with breakouts away from balance or flags. This is, typical of a breakout situation. We have the flag forming. Once we accept outside the flag to the upside, the flag is proven true, and we can look for the market to continue its move to the upside. Nothing happens the same way exactly twice, ladies and gentlemen. James, I like that. Put the candlesticks in the same color so we can really challenge ourselves. This is challenging enough, right? So again, flags, one of my favorite patterns. And then the next pattern we have here is double or triple tops and bottoms. Some people would call this a W bottom. In the opposite direction, it would be an M pattern or a double top or a triple top. The market comes down, puts in a low, rallies, comes back down, tests the low. Now, there's lots of hypothesis that said a true double bottom should not go past the previous low. There are those that say it should go past the previous low. Just another thing to tell you that there is no 100% right way to do anything. Any important levels should be viewed as zones. And, if we saw that we came back down here and we saw that it was rejected before, it's rejected again, and the market continues to move higher. What do we see here? We see a little bit of a bull flag. Once it breaks out, we see the continuation to the upside. It's an upside digestion pattern. This is one of my next favorite patterns. When the market is presenting in a triangle, a falling triangle or a rising triangle, or kind of a pennant formation, this is the market really kind of coiling in for a move away from this. And again, these patterns offer cheap opportunities at the high and at the low of the range that you're currently in. It's similar, very similar to really just a range bound market, but each high is lower. We may have even lows. We may have highs that are rising over time. That would be more of a pennant formation. Point being is, as long as we have some points of contact, the reversion trades, if we're range bound, we fade the extremes until there's a breakout in one direction. Obviously, this is a gap breakout. We couldn't close the gap. Gap rules. We'll look for continuation to the downside. We're going to be talking about gaps here in just a couple of minutes. The use of trend lines. Okay. If we're going to be using the triangle pennant, the pennant formation, if we're going to be using the bull or bear flag formation, we're going to be depending quite a bit on trend lines. This is obviously the S&Ps probably coming off of the recent lows that we had from COVID, but you can see that we got a point of contact here, another point of contact here, another point of contact here. This market is truly respecting this trend line every time it gets to it. 1, 2, 3, 4. When we have the opportunity to buy against a trend line like this, it gives us that opportunity to buy a market that is exhibiting strength during a period of weakness. It allows us much better ways to be able to limit risk. If there is a breakout below this trend line, we would probably look to go with it. But as long as we hold above it and we keep bouncing off it, it gives us the opportunity to buy a strong market in periods of weakness. Trend lines are easy to probably put too many of them on your charts. A true trend line is going to have 3 good solid points of contact. And to me, points of contact are subjective. If there is a one that stops a little bit short, I'm going to be looking at that as a potential point of contact. If it gets a little bit through it and rejects, that to me is a solid point of contact. Gaps. When the market opens a regular trading hour session outside of the previous day's range and value, it creates a gap. In other words, there's no overlap between regular trading hour ranges. There's a general rule for gaps that we talk about on the forecast and on the recap sometimes. If we open with a gap and we can't close the gap relatively early, we trade in the direction of the gap. And in this case, that would have been the right opportunity for us. The market opened, leaving a gap, no effort to close the gap. We end up moving this market higher. Gaps can also be used in the future. Gaps are considered weak structure levels and visual targets if the market returns back to that neighborhood, if you will. So this market can go considerably higher, but if the market returns back to this neighborhood, back to this area, these gaps tend to get filled. Support and resistance. There are those that believe in support and resistance. There are those that don't. Support and resistance are really just visual levels where price exceeded and there was excess left. When the market is range bound, the support and resistance levels are usually quite obvious. The market has been rejecting price below this level. That gives us an opportunity to look for longs against this level, because if there's an acceptance outside of it, it's going to tell us that our long is probably wrong and maybe we should be looking to go the other direction. Okay, we've got some points of contact here. I believe there's one that's off this picture. But when the market comes up to it, if we continue to use that level to manage risk, we can get some decent rotations back and forth. Here's the next move up to it. Here's the breakout above. Similar situation to range bound, to bull flags, to bear flags. We work the extremes towards the middle until there's a substantial breakout in time or momentum or volume, and we go with breakouts away from balance. Support and resistance the same as supply and demand? Are they the same? Well, if you think about it, if this were, let's say, corn, and this is a daily chart, depending on depending on the price range here, you might find users of corn buying dips down in this area. Okay, you may find longer other time frame traders interested in accumulating longs down in this area. On the contrary, you may find that producers, those that are trying to sell that product and make money on it, are looking at this level here to sell some of their product. Now, sometimes things change, and our producers are probably going to have to chase this a little bit to get back in. So when the prices change, of course, the longer time frame traders need to adjust. So that's one of the things that I'm looking for at weekly kickoff levels. If you guys are not familiar with my weekly kickoff levels, that's what I'm thinking is longer time frame. Other time frame traders are going to need to adjust inventory. And in this regard, if there were longer time frame sellers up here when the market became directional to the upside, believe me, they probably had to adjust inventory. The head and shoulders. The head and shoulders and the inverse head and shoulders, another one of my favorite patterns. We have price coming up to, this is a reversal pattern. Price has to come up to, we put in the left shoulder, we put in the head, and then we put in the right shoulder. What we're looking for in this regard is the base here of the neckline to the top of the head. That distance, once we break out below the neckline, becomes our profit target to the downside. And we don't see that this has finished down to the profit target here just yet, but that's one of the things about the head and shoulders pattern and a bunch of other patterns that offer you the opportunity to find a probable profit target. You get the base of the neckline here to the top of the head. When we break out the same distance as the neckline to the top of the head is our profit target to the downside. Okay, now we could go on and on for hours and hours about the different technical patterns, tools, technical analysis, candlestick patterns, which we should probably put together a presentation about candlestick patterns. It's really something that requires, I believe, really some pretty good self-study. We've only touched on a little bit and a couple of the different patterns that are available in technical analysis. So I'm going to challenge all of you to take it from here. Many of you that are here probably are well beyond the research and the things that you've learned here, and that's okay. We want to make sure we get the opportunity for everybody to have the chance to learn a little something. And hopefully that's the case today. Maybe you're a more advanced trader or somebody with more experience. Maybe there's something that you didn't know about today, and you know that would be good. So without confusing and going too far too fast, I'm going to challenge you. This site right here, school.stockcharts.com or just stockcharts.com is a really good reference, online reference that is non-biased. They really do a good job of explaining technical analysis. They do a good job of explaining candlestick patterns. It's really a good website. It's very searchable. It's very easy to use and very clear and clean in the verbiage that they use to explain some of this stuff. And of course, you know, we've already got on there the CME group education. if you're interested in learning more about candlestick charting, Steve Nissen is from what I understand and from what I've read, the guru of candlestick patterns, candlestick charting. Candlestick Charting Basics by Steve Nissen. I'm sure you can find it on Amazon. You may even be able to borrow it from your library. If you live near a library, maybe you can just borrow it and take all that information and pack it into your brain without having to buy the book. But he's got several books about candlestick charting. And again, he's probably one of the best. So you guys are all talking about some of the sites that you've learned from, some of the sites that you're looking at. I'm just going to leave this up here now and see if we have any questions. The putting together this program today was, I mean, it's kind of challenging. There's so much information for me to handpick and pick a few things for everybody to learn is just really the beginning of learning about technical analysis. Not only is technical analysis sometimes useful, when you use technical analysis with another form of analysis like volume profile or market profile, which we're going to be learning next week a little bit more about volume and market profile. When you find confluence in two different forms of study, those can be some of your more powerful opportunities. So we got some time left for questions, and I'm looking forward to any questions that you do have.
We sure do.
All right.
All right. Let's I'll feed you some and I'll take a few to break it up, Hogue. To start, are technical patterns more reliable when looking at higher time frames versus shorter time frames?
Yes and no. It's a hard question to answer because you've got to look at the bigger context around the chart pattern. The longer time frame, you know, there's bigger players that are involved in those charts, in those patterns in the longer time frame. So I'm going to go with longer time frame charts for 100.
Yeah. I think, and tell me if I'm wrong in this reasoning here, is that if we're talking about any analysis you do, the more information that's in it, the stronger it would be. If you're looking at super long term, like say, for instance, there's a very clear trend. If you look at interest rates, US interest rates on the 10-year since 1980, they have been consistently going down with very few, like a very clear trend. On that long a time frame, are you likely to see a head and shoulders, and would you trust it? I don't know. Like if I would take a multiple year trade to complete a head and shoulders, but you probably don't want to do, I would say, like something that's in an hour or a day is probably better than, you know, a minute or something like that. But as John says, it depends. I one that I'll take real quick, and you can add anything, Hogue. A general question from James. It says, general question about futures. Is this an asset typically traded by those who have traded equities already, typical stocks, or do you see traders who are brand new to the market come to futures? I think by and large, I can only speak for our traders at Topstep, but I can speak to this personally too. I think that almost everybody who trades initially probably gets involved in stocks or is familiar more with what stocks are. Especially if you're day trading, there are advantages to trading futures as opposed to individual stocks as far as the leverage. You trade in the index. I mean, if you're trading options, there's no like time decay the same way. But yeah, I think people usually start in stocks. Oh, you have anything to add to that?
Yeah, I've seen a lot of folks come to futures from trading options as well. And options are they've always been more confusing than futures to me, but a lot of options traders that have come to us have felt that trading futures was confusing. So yeah, most people when they start trading or thinking about trading are really focused on stocks. And then they usually find out about futures at some point in their trading journey and come to check it out.
Well, the allure of options is sort of the lotto ticket thing of it that doesn't exist quite as much in futures, where
Mm.
you can hit the 100 bagger theoretically. I think why a lot of new retail traders who trade options, I feel like are almost exclusively buying put and call options on stocks.
Mhm.
And or say if you're doing it on like SPY or something like that, then you should probably be trading futures, because you're kind of just all the options market makers, they're the ones selling it, right?
Right.
It's a much better proposition to be the one selling options rather than just buying calls and
Although
puts.
much more dangerous.
Yeah, I mean, you got to be hedged. I mean, that's why it's difficult for retail traders to do it. You need a lot of capital to be the person out there selling the options. Um, oh, do you look for the same? This kind of ties into the first one, but do you look for the same pattern on multiple time frame charts for confirmation?
No. So what you're saying is if I'm looking at a daily bull flag, do I look for a bull flag in a shorter time frame? Maybe, maybe not. It really depends on the kind of range that you're talking about. But I don't usually, see.
Well, kind of
Well,
by
yeah,
definition.
I mean, if you look at it like the daily chart, and there's a 2 or 3 day pullback and a strong trend to the upside that appears to be a bull flag, you're going to see that bull flag on a 30-minute chart as well. So, just as, but if I'm looking for a chart, a trade on a 5-minute chart, which I wouldn't do, that's, part of a uh, pullback bull flag on a daily chart. Am I looking for a bull flag on the 5-minute chart and with which to get into? No.
Okay. Um,
Yeah, I can
any
show
tip?
you some. I can show you
Sure.
something right here that kind of goes with what we're saying here. And I set this up so we can see this. Okay, so here's crude oil. So here's the daily chart. We know that the market's been moving higher over time. We've had 1, 2, wouldn't call this a bull flag, but now we're in another bull flag. So if we see this bull flag on the daily chart, if we go to the 30-minute chart, we're still going to see it there. It's going to be a little bit more noisy, but we're still going to see it. And I think, we are, at risk of breaking out and continuation above this. Am I seeing great momentum or participation or volume up here? Not really. We got to judge if this breakout is going to fail or if it's going to continue. But the longer it sits up here, the more it's going to be showing acceptance above this trend line, and a potential new move to the upside could come into play.
One slight addendum, because another question is, will you combine patterns in longer and shorter time frames? There's another question. So like that was about like, do you look for confirmation of 2? Do you see a pattern in the longer time frames and then look for another one in the shorter, say?
Not necessarily. If I'm looking at a daily chart and there's a pattern there, I'm going to be looking for my entry based on the pattern, based on the pattern in the daily chart. So it may, a daily chart may take days for me to get to a level where I'm interested in getting into it. In other words, if there's let's say it's just a trend line that the market's been respecting on the way up. Well, it may take days for me to get the opportunity to buy the weakness near that trend line. So there's probably not going to be that much shorter time frame charting information in that decision because it's based on a longer time frame. Does that make sense?
I think so. I'm also reading through questions at the same time, so I might not be the best person to ask, but I assume. I think this might be a comment. Oh, there's a question there. Hi, Hogue. From having listened to Jim Dalton studying the ways of evaluating who's in the market, his type of technicals. I think it might be this might be a little bit this type. I'm wrong to think that every time I see an unwind in the shorts, as we're seeing in the ES and NQ as we speak, I always have a picture in my mind of larger time frame players saying, okay, let's squeeze them all out. Is this the bigger game of the day to get participants short and then push them out? Technical analysis becomes a way of seeing who's in the market.
There's ways that you might be able to see who's in the marketplace looking at the market profile. If you've been listening to Jim Dalton, there's other things that are involved too. We're going to be talking about volume and open interest on Thursday this week, and an intro to the profiles on next week. So I'm trying to think of the best way to answer this. The ability to be able to sense the presence of other time frame traders, longer time frame traders, is one of the things that I really tried to study when I stepped out of the trading pit, because no longer was I going to be able to see the major banks and what they were doing. I was no longer also able to recognize when my time frame traders, my direct competitors, were getting caught short or getting caught long. We used to say, what's the pit? Is the pit long or short? There was always something we wanted to be aware of when we were thinking about taking trades. This thing that happened yesterday, did we get too short? Yes, I believe we got way too short yesterday, but who were the buyers that came in? Okay, so we have this big excess on the daily chart after what happened yesterday. When I think about who were the participants that stepped in and bought that market, was it the shorts? Was it new longs? Or was it a combination of the two? So what I'm going to be thinking is, okay, if it's new longs, we should have an accumulation in open interest. And we're getting a little bit ahead of ourselves. And open interest is something we're going to talk about Thursday. An accumulation of open interest in a directional move. The yesterday started to the downside. The real volume came on the way back up. So knowing that estimated, we added 24,000 new contracts to open interest yesterday on a rejection where we probably got too short, and we saw other time frame buyers begin an accumulation of potentially new longs. So we know we got too short. Buyers came in, sellers backed off. On that move to the upside, the panic that ensued yesterday on that big move to the upside, that was all time frames acting in concert. The short time frame, medium time frame got too short in the hole. They got over their skis. Whoever it was that came in and accumulated those longs, they caught their competitors the wrong way. And what our job is to be able to use the tools that we have in hand to recognize when our direct competitors are the wrong way, and to use that to our advantage. So, that move yesterday was substantial, important, and we're going to have to wait and see how the market digests that information to find out how really important it was.
Very nice. We'll go through a couple quick ones here. Any tips on identifying stop hunts by institutions or market makers?
Well, you can you can make an assumption that in short time frame, you're going to see stop runs. Here's crude. So let's look at the S&Ps today. We're relatively range bound, right? Now we're starting to push to the upside here. If we look at the TPO charts, let's see if we can get this up here. $19.25. Okay. All right. So this is just a random day. This is actually the 17th, but it's a small profile. So I want to show you. So we have a period here. Okay. Okay. We have a period trades the initial balance, B period, C period. Nothing ever goes past it. This is MLK Day, by the way. Nothing ever goes past it. If there was anybody that was willing to push the market that next step, you could be relatively positive there were some short time frame shorts at that level. A period held, B period held, C period held, D period held. Short time frame traders are focusing on this for their opportunities. Hey, it's a triple top. If there was somebody willing to take that next step, you know all their stops are right here. Okay, now look at the other side of this profile. We have A period, which is the low. It's a normal trading day. F period trades down to here. G period trades 2 ticks past F period. Why? Short time frame shorts, short time frame stops. And then the market turns and closes wherever it closes. When you look at the short time frame traders, how often do you find that there is a collection of stops? Well, let's look at gold. Gold, we had some moves here. Okay, if I'm long gold, and I bought it right here, there's going to be a group of traders that may be long that, and what they're going to do is they're going to take their stops and they're going to move it just below the previous bar. When this bar closes, they're going to move their stop to just below the previous bar. When this bar closes, they're going to move their stop to just below the previous bar. When this bar closes, stop goes just below it. This bar closes, stop goes just below it. In this case, it's working nicely. When the market is one time framing higher, in other words, consistent highs and consistent lows, higher highs and higher lows, it's going to work great. But you're going to have the situation where there's always going to be that one day, that one bar that comes and takes out all the stops off the low. So when you see that in the profile and you see the end of a 30-minute bar, and based on the context, you can say, wow, that looks like a great place for short time frame shorts. You can bet that there's a lot of them. And that if you are thinking about getting short there, think about where they've put their stops, because the algos, they know where those stops are. And they've already placed orders to take the other side of them. Does that make sense?
Yeah, and then we'll touch more on this when we do market profile and things like that.
Mm-hmm.
Dan asks, how far down the TA rabbit hole does Topstep go? Gann astrology charts, tea leaves. I think it's in jest, but it's true, man. There is some wild stuff out there that just wild technical analysis people do. It becomes sort of there's a certain group of people. It's like an obsession that they really go down the rabbit hole, so to speak. So there's another question that I think I'll take right now that ties into this. Which of these tools do you really use on a daily basis? Among tons of chart patterns, indicators, moving averages, etc., it can really get too confusing then to look at the trend daily and then drill down to the 30-minute to find entry. How do you do it? how do you piece it all together? I know this is a long question, but we can give a peek.
Well, the last two sessions next week, Wednesday and Thursday, we're going to be talking about putting a business plan together and putting a trading plan together. And you're right. When there's too many indicators, too many chart lines, too much of this, too much of that, it gets very confusing and very difficult to make any decision, because all of those different tools are going to be telling you something different. And that's, part of the reason why we wanted to put this together is you want to take the time to learn enough to figure out what instruments, what timeframes, what tools, and what charts speak to you, and to really focus on that. You don't have to be overly complicated to be a profitable trader. Matter of fact, it might even be quite the opposite. A lot of people talk about KISS, keep it super simple, and nothing could be further from the truth. When you see my charts, you're seeing charts that I'm taking trades off of. I don't have a lot of indicators. I don't, if there's indicators on there, it's because I'm explaining something to somebody. It's about the 30-minute chart, the market profile, volume, open interest, delta, which is also something we're going to be talking about, and just thinking about what direction the market is attempting to do, if it's doing anything, and then making an assumption of how good of a job is it doing getting there. Now, we had the auction yesterday, the auction process, and a lot of that is, if the market's moving higher, is volume continuing to grow, or is it at least maintaining? If it's not maintaining, is open interest continuing to increase in that direction? Areas of balance, are they getting closer together? So there's delta too, which we're going to talk about with, I think it's volume and open interest, and we're going to introduce delta to the system too. But delta is basically, if you see price moving higher in a day time frame with relative consistency, and delta is increasing in negativity, there's an indication that you may have longer other time frame buyers in the marketplace. And you may see that the shorter time frame traders that, like us, P shooters, our direct competitors, are ending up getting too short, and by the end of the session they're going to want to go home flat. So you take advantage of when they finally capitulate. So I'm getting kind of far away from your initial question. Is take a look at a bunch of different things, play with them, see how they speak to you. Through a system of elimination, start taking the ones that don't seem to make sense to you and take them off your charts. Look for a way to simplify your strategy and your view of the market. It doesn't have to be complicated, but it does have to be consistent. The lens that you choose to use, you should use. There's nothing that's going to, guarantee success. There's nothing that's going to guarantee failure as well. It's all in your ability to look at the market through a consistent lens, consistently, to find consistency. So don't fret if you feel like you're overdoing things. Take the ones that don't seem to help you and take them off, and keep moving forward. There's things you're going to learn along the way that you didn't know that you now know, that might take the place of something that you're currently using. But you just want to be cautious not to over analyze. Paralysis by analysis is a real thing.
All right. How often are you using fibs to go with your pattern recognition? I know I don't personally really use fibs. So what about you?
I don't either. Although every fib has 50% on it, which isn't even actually a fib number, but the halfway mark sometimes comes in very useful.
The BFRN.
Yep.
Big, choose the F of your, however, big F, a round number.
Yep.
Are algos designed to counter pattern traders? So in one of these classes, I'll talk more is I have experience working for algorithmic trading company, and we're getting closer to time, so I won't go into all that now. I think that takeaway is that like I think that sometimes people use algos to be the boogeyman of everything. They're not as sophisticated as you may think. At the same time, though, why we say don't try and be a market maker, they're really good at that, much better than you. I just as a quick preview to when we talk about that is they use all sorts of high speed, like just a quick overview. We had a high speed line between New York and Chicago, and we would trade futures here, bond futures, and the cash bonds in New York. So they're essentially more or less fungible, the same thing. And if you're fast enough with that and you have the right computer infrastructure, you can basically see which one of them moves first, knowing full well the other is going to move an instant later. And that's how they get the edge. And if you're looking at, say, bond futures or anything else that has a similar spread they're doing, you don't see that other half of the market. So you're generally trading against a bunch of companies that for that split second know to either pull their orders or to hit it. So when people try and say, oh, but my plan works on this, it's like, okay, maybe on a simulator, but we have yet to see much success of that in like a real live market. So we'll talk more about the algo stuff later, Christo. We touched on a number of different futures assets, all with different traits. Are there assets in the futures market that you suggest to start with or move to as you're more of a veteran? I would say that, the ES, I think, is a good one for people to start trading because it's more liquid. It's not as whippy as the NASDAQ. I think people understand it. Maybe the most intuitive to understand is, if you were like a complete beginner, is like oil. But I hesitate because that one tends to move a whole lot more. It can move erratically, but like it's 1,000 barrels of oil. How much are you going to pay for it? Right. Someone mentioned ZB. Bonds are close to my heart. They're good. If you're just going to focus on technicals and do it, I think bonds as a product in general, if you're a beginner, the dynamics of bonds are just, I think, harder to understand. I worked at a bond trading firm for 7 years, and I do not know nearly enough about bonds. They're a complicated thing. What do you think, Hog?
I would agree. I think the ES is it's not too fast. It's liquid. It offers easy in, easy out for beginners as well as professionals. I was in the S&Ps for years. I still trade them. I think they're a great product, and I agree. Higher volatility products are not necessarily a good idea for newer traders.
Cool. Answering a few. We won't be able to get all these questions. JD, if you want to try and type answers to a few of them, maybe that you can. How many factors do you take in consideration for your entries? Do you have a checklist?
Yes, and that checklist is a list of one. Is this entry close to a point of invalidation? Am I close to my stop?
Yeah. What data subscriptions are most useful, necessary to day trade NQ? Well, you need to see what do you think, Hogue?
Like news?
I think they meant data subscriptions. Like, do you need, I forget what the packages are for that, but I mean, as long as you have the live NQ data, I'm trying to think if there's any, I guess we need more context for that question. At some point, Hogue, we'll have to share your settings for your TPO chart.
Okay.
Maybe we'll make a note to do that. Maybe one of these days. If you had one pattern indicator trade off of, what would it be?
Market profile.
I knew it. out of curiosity, after 38 years trading, and with your dad and your own success, what keeps you going? Have you ever thought about what keeps you trading from retiring or whatever you want to do now?
I'm too young to retire. I enjoy this. I enjoy all of you. I enjoy talking to people. I enjoy what I'm doing. I could be a little bit more active because, this is kind of a sedentary life sitting here trading, and I'm got plans to do that as well. But I'd be bored.
Yeah. Well, working keeps you, like, even if you're retired, you got to do something. It's what keeps you, not that,
Mhm.
oh, you're just 38, but,
Right.
when people get older, it's, I have one of my good friends, his wife's grandpa is still like a professor of medicine or something, and he's like 95.
And he's probably just happy as a clam doing that.
Yeah.
But you're 38. It's been 38 tough years.
Let me see as we end up here. We have some thoughts on internals. In the answered question, I think I answered something similar to this. I gave an article we have on Topstep. Let me see if I still have that in there. Do you have thoughts on market internals, such as advanced decline?
It was always like posted above the trading pit. Just like everything, I think there's times when it's going to be helpful. It's nothing I focus on.
Yeah. I think that answers the other one too. Have you ever thought about writing a book, Hogue?
Thought about writing a book.
Then you'd have to learn to read, though.
Yeah. You have to read one before you write one, right? I've had other people suggest it, but not necessarily about, trading, technicals or anything like that. More about stories from the trading floor.
Yeah. Oh, yeah. Those are great. I think people are hungry for that. I see JD answering this one. What would you recommend to someone who's starting the trade between Forex and futures? Hey, we're hugely biased here. And maybe back to the old point, we might go into some stories at the end or have like an after hours trading class.
Yeah.
What would you recommend to someone starting to trade between futures and Forex? As I was mentioning, we're hugely biased. I'd say futures, mainly because I am not personally as interested in the Forex markets. I do think that maybe the big one is just by nature, and I don't trade Forex, but I think Forex kind of encourages too much leverage, but also tell me if I'm wrong here, you have to pay the spread, right, when you're trading Forex?
Right. You always pay the offer or sell the bid.
Yeah. That doesn't jive well with my style, Hogue, but like people love Forex. It's a way. I mean, if you look at like just go to Google Trends and type in futures trading versus Forex trading, I think it's like 4 times as much volume for Forex. So,
for sure.
Yeah.
Yeah. The rest of the world, they all know about Forex.
Yeah. I think you just have to be careful in Forex because it's more of a Wild West trading. Like if you're trading futures through the CME, that's as legit as it comes. And don't get me wrong, like there's plenty of legit Forex places, but there's a lot, I would say, too, maybe, I don't want to get sued for anything, but like a lot more scammy activity involving Forex.
Well, the CME, the Merck products, futures products, there's only one liquidity pool. Everything goes through the exchange. And Forex, there's lots of different liquidity pools, lots of different brokers, lots of brokers working in ways that may or may not be on the up and up, I guess.
Well, taking the other side of your trades.
Right.
Yeah. So do your research before you get into that stuff. Boom. Is it possible to have a session where you can see your trades and the reasons behind them? Yeah, we could probably do that at some point. Or
yeah,
cool.
We'll work on that.
And I think we cleared it out. And I will. Oh yeah, the Bake of Cyprus. What's your money? Yeah. Oh, Forex. Hogue, do you ever trade Globex? If so, what indicators do you recommend for trading Globex?
Like overnight.
That's just what the question said. So I assume that's what it means.
Generally speaking, unless there's something very specific that I want to hold a position, or I'm looking for a specific level that might get hit overnight, I'll think about it. But generally speaking, I'm a day trader. I stick to day trading because I like sleep.
Yeah, me too. One last point also someone said about like a virtual trading room. There is the Discord. I mentioned this on one day, but I'll say it again in case anyone's new to it. We might get into some live trading. The issue becomes that Topstep is not a CTA, a registered CTA, which is a commodity trading advisor. So we have to be a little bit careful about giving things that could be specifically construed as direct commodity trading advice. So that is the hurdle in front of us, but hopefully we can work something out there.
Mm-hmm.
I mean, Spencer's not wrong with that too, is that like we'd have to roll out small. You can see from our business end too how it might be a little bit of have unintended consequences. Say if Hogue, say you were just had like a live trading room and then we have a lot of people watching it, it could significantly impact what our risk exposure is, so to speak.
Sure.
I'm just being completely honest out here.
Well, and then there's the fact that I'm not always right. If we have a trading room and somebody's in a trading combine and they take a trade recommended or watching me do something and it's a loss, there's not just as a loss, they could be, saying that I'm giving bad trades to keep you in the trading combine. I mean, there's all kinds of trolls out there that will try and twist anything into their benefit. So it's something that we have to be really careful about.
Cool. Well, reach that point and I'll make a mental note. We'll talk about algo trading after one of these days. But in the meantime, great stuff today, Hogue. You want to sign us off?
Sure. Thanks, everybody. As always, these it's always fun to talk to everybody. It's what keeps me going in this, and tomorrow we're going to be talking about fundamental analysis. It's not a real long class. That'll give us some time to maybe discuss some other things, but fundamentals are things that we got to keep an eye on, but generally speaking aren't going to be real urgent in our trading decisions. Of course, there's things that happen that change things really quickly with fundamentals, but it's going to take a look at what some of the fundamentals are with the different asset classes. And again, looking forward to tomorrow, Friday, volume and open interest, and I believe an introduction to Delta. If you're not familiar with Delta, you may find this one to be really interesting. And then, of course, next week, indicators and tools, introduction to the market profile, and then business planning, and the last one, context, hypothesis, and trade planning. So thanks for joining me today. Thanks, as always, to Jack and John for hanging out with me. It's always good to see your smiling faces. We don't get to see that many people, and I enjoy it. So get out there, profit today, trade well. You'll see me for the recap today. Dan's not doing the recap this week. He's got some other things going on. So I'll see you in a couple hours. Trade well.